Brandon Wendell, and I'm an instructor with Online Trading Academy. And today I want to talk to you about an option strategy you may or may not be aware of. It's called a synthetic position. What we are doing is artificially creating a stock position with options. Now, why would you want to do this? Perhaps you want to take advantage of the leverage that options offer you and possibly even the lower commissions that are available, rather than simply buying into a stock. Or if you were looking to hold a stock to profit from the downside movement of the stock, you can only hold a short position intraday. With a synthetic position, you could actually mimic a short in the markets and hold that for a longer period of time. Let's take a look at what's going on. What I have here on the board is a risk profile graph. Now, if we see here, there's a zero line. We go above the zero line and we're making profits in our position. If we go below the zero line, we're making a loss in that position. As the price of the stock goes higher, we move further to the right. Now, when we buy a stock, let's say we buy a stock for 900 rupees. If we buy that stock for 900 rupees, if the price of that stock goes up, we make money. If the price of the stock goes down, well, obviously we lose money. Now, with a call option allows us to basically buy stock from someone at a predetermined price at or before a certain date. Now, with that call option, the risk profile is slightly different. We still make money when the price moves to the upside. However, because we must pay for that right, our break-even level is slightly higher than it would be for the stock. The advantage of this, though, instead of profiting or losing right at 900, with a call option, we can only lose the amount of premium we have spent for buying that option. No matter how low the price goes, we cannot lose any more than that one particular premium that we have paid. Now, if we want to make this line go a little bit closer, which means that as the price of the stock moves up, we make rupee for rupee the amount of gains we would make in the stock price just by owning the stock, we can do something else. We could actually sell a put. Now, what happens when you sell a put option is that the traditional risk profile, let me put that in, looks like this. A put goes up in value when the prices drop. So if we sell a put, we would actually lose money as prices drop, but if prices go up and we've sold the put, we get to keep the premium. Well, if you recall the risk profile of the call option, it was almost the inverse of what we just saw here. Combining the two of those, where you are collecting premium and paying premium, will reduce your cost basis. So literally, you are taking two risk profiles, one that looks like this, and the put, combining them together and creating that same risk profile you have in the stock. We simply eliminate those wings there that tell us how much we can potentially make or how much we could potentially lose. We have the exact same risk profile as we do with the stock, and because of the way that we have changed what is called delta of the options, we shift this to the left and it literally moves one for one rupee-wise with the stock. When the stock moves up by 1 rupee, you gain 1 rupee in value on your synthetic position.